Welcome to Markets in a Minute. My name is Austin Duke. I'm financial advisor and chief investment officer for Diamondback Financial Services. We are a wealth management firm focusing on clients who recognize the need for solid financial advice, who don't want to invest on their own, but still want to be educated through the process. This is the Monday, February 9th, 2026 edition. Let's get started. Investment values fluctuate on a daily basis for a variety of reasons, and our job is to figure out what moves we've seen, why we've seen them, and where we think we're going from here. Diamondback Financial is a long-only investment firm, which means we keep your money invested in the areas we feel offer the best opportunities for growth instead of trying to time the market. We focus exclusively on traditional investments of stocks, bonds, and cash. So we analyze fluctuations in the stock market as well as interest rates to help drive our overall investment decision process. So we'll start by looking at the stock market as measured by the S&P 500. Again, this is an index of the 500 largest companies in America. And for the 2-week period that ended on Friday the 6th, we were up 0.24%. So for the 2-week period, again, essentially flat. And that comes off of a 2-week period that was down 0.08%. So really for the last month, we've fluctuated around the same level. We've got a year-to-date gain of 1.27%. Next, we move on to interest rates as measured by Treasury bonds issued through the U.S. government. We have interest rates listed over here on the left-hand side. We've got maturity lengths listed on the bottom axis from 1 month all the way out to 30 years. Each of these dots represents an interest rate for a given maturity length. The green line is where we finished on Friday the 6th, and the brown line is where we were 2 weeks ago. So really not a lot of changes on the short end as well as the long end, but we had some decline in the interest rates in what we would call the medium term. If we look at a chart of the 10-year Treasury over the past 5 years, we can see that we came from very, very low interest rates here between 1 and 1.5%, with interest rates now over here on the right-hand side. And then interest rates went up in 2022, all the way through 2023. We hit about 5% on the 10-year US Treasury. And arguably, we've seen it come down in this not so steady decline over the past 2 years. But we hit a bottom in October of last year. We think, or we're arguing, we hit a bottom, and that we're starting to see an uptrend here in the last 4 months, from just under 4% to where we finished at about 4.2. However, if we just look at the past 2 years, it's really we think it's been pretty flat, which has really allowed the stock market to do well. It's provided more stability for companies who are attempting to invest and do capital expenditures. You know, the more certainty that companies have in what interest rate they're going to be paying, the more likely they are to borrow money and invest and expand their operations. So, interesting to see how it's been. We wouldn't get too concerned if we did see it get back up to 4.5% like we did here in at the end of 24 and beginning of 25. If we did see it get closer to 5%, that would have us feeling like we're potentially going to see a decline in the stock market, as people would be selling stocks to get into U.S. Treasury bonds paying 5%. Because historically, you know, since we had really high inflation back in the 70s and 80s, and interest rates have come down, 5% seems to be the ceiling where people say, okay, you know, this is kind of a once in a lifetime opportunity, not quite a lifetime, but an opportunity to get in and get what we would refer to as the risk-free return on a U.S. Treasury bond. Quickly looking at spreads on high yield corporate bonds. Again, we like to look at the spreads as an indication of probability of default for these companies that are not considered risk-free. The spreads have been very low, what we would refer to as tight credit spreads. And they're pretty much still there. We've seen a little bit of an increase here in the last week, but nothing that's really giving us any cause for concern. All right, for recent developments, there are two stories that we want to discuss. and give our opinion about. So, first, 2 weeks ago, we brought up these charts that showed we're seeing a lot more margin debt. There's people who can borrow money to then invest in stocks or, whatever investment of their choice. And we pointed out that we're at record levels and that this level of margin debt over here is rising faster than stock prices, leading us to believe that maybe people aren't investing in stocks with the margin debt. So we had a situation on the around the 28th of January. We think that it had maybe something to do with President Trump nominating Kevin Warsh to be the next chair of the Federal Reserve, where gold and silver had been on very extended rallies over the past year or so. And right around the same time that they announced who President Trump had picked to run the Fed, we saw that bubble burst. Commodities markets aren't as big as the stock market, so it's a headline, but it's not something that necessarily causes a lot of concern for us in the stock market. But gold was down 12%, silver was down as much as 36%. Right, so if you look at the charts that they include in this article, you can see that, up until about the end of the summer, beginning of October last year, gold and silver had been doing, not a whole lot, but something happened, something changed that uh, effectively caused people uh, to invest and to start buying up these precious metals. And again, right around the 28th is when the bubble burst, and we have seen a precipitous decline. Now, I mean, things don't go up forever, and a lot of times they'll stall out. We just don't know at what point or what's going to cause it. We just know that those things are going to happen. So it's possible that people had been borrowing money to invest in these commodities because they had just been going up, and it's that fear of missing out, and people are making money investing in gold and silver, and so people want to get in on it, and everything works until it doesn't. But that was an interesting thing. And again, if we look at the stock market on the 28th, right, not a whole lot happening there, but we see this precipitous decline the morning of the 29th. So if you borrow money on margin, you get what's called a margin call. If the value of the investments in your account go down, you either have to add money or you have to sell something in order to cover the money that you've borrowed. So precipitous declines followed by some buying activity as people are done with their margin calls, and those who have cash or who aren't using margin, like our clients, um, are able to come in and then buy at those lower levels. We did see the second story that I wanted to point out was this sell-off that we had during the week, which, I mean, we can call it a sell-off, I suppose. Anthropic released a new artificial intelligence software or tool that spooked investors in software-related stocks, right? Software stocks, their business model is software as a service, it's subscription-based, and if artificial intelligence can come in and do something faster and less expensive, it can disrupt that business model. So it started with software stocks, and if we look at the charts again, that article, it was Tuesday morning on the 3rd. We saw a pretty steep decline going in on the 3rd. Again, the morning of the 4th, again, the morning of the 5th. But we do see these afternoon rallies, which are always interesting because we think it goes hand in hand with the margin debt. People are getting the margin calls, they're selling things in the morning, and then we're able to have rallies in the afternoon as those margin calls are fulfilled and people are going back in to buy other investments. Still haven't heard for sure what it was on Friday that caused the market to go up, but I mean the market rallied 2% on Friday by itself, which essentially eliminated all the declines that we had seen throughout the week, and no major headlines there, but those were the things that we saw. We're getting earnings reports. We are getting some of the Magnificent Seven companies reporting, and they're indicating that capital expenditures, especially around artificial intelligence infrastructure, is more expensive than they had anticipated or that professional analysts had been expecting. So we're seeing what I would refer to as maybe these little mini bubbles that are bursting. We are seeing a lot less correlation between individual stocks within the stock market, suggesting that maybe this is no longer going to be 100% driven by the Magnificent Seven, or maybe not 100%, but um, maybe the other 493 are finally going to start performing and keeping the market going. We don't have to rely on Nvidia and Microsoft and some of those other names that have been driving the market for the past few years. As far as our expectations portion, we don't really have any expectations for the next 2 weeks. We got the Olympics going on, which we think is going to take a lot of people's attention. We do have President's Day coming up, which with President Trump, you never know what you're going to get. So there may be some announcement he's preparing that could send the market up or down based on what he's thinking. But we're kind of in the heart of earnings season, and we're going to get some more economic data that hopefully will help us understand where we are and where we think we're going. But uh, we really wouldn't be surprised if we're sitting here 2 weeks from now and we say, okay, well, the market was flat again for the next 2 weeks. So unless we see something really significant, we're just planning to keep steady as she goes, and we'll see what happens over the next couple weeks. All right, as a final word, we don't always know what's going on in the markets. We do our best to connect the dots and try to identify what we're seeing and what makes sense. But I had a little bit of an eye-opening experience that led me to believe that maybe there's a little bit more risk-taking happening in the markets these days than I had previously given it credit for. So I was invited to a mentoring networking lunch at the University of Utah a week or two ago. I graduated from their Master's in Finance program in 2010, and I've been teaching a class for the last 6 years at the university to their finance students. And this lunch was for the incoming class of students who had been accepted to the business school. And I was among other professors and administrators serving as an adjunct professor and alumni, just trying to answer questions, kind of tell them about myself and my career path, etc. And I was working at Zions Bank during the financial crisis back in 2007 to 2009. And as I'm telling these students my story, I'm realizing that these kids sitting at the table with me were all born during the financial crisis. And I don't think I'd ever felt more like a dinosaur than I did that day. But these kids didn't live through the financial crisis. They don't have the PTSD or the risk aversion that the rest of us may have because of how decimating that event was for us and our investment accounts. So and they lived through COVID, but we had enough bailout from the government that the decline in the stock market was over in what, 2 months? So there's a bunch of individuals now coming into the investing world, to the corporate world, who have never really been through a recession, and especially one like the financial crisis like we went through. So I feel like there's a lot more speculation, a lot more risk taking from some of these younger individuals who are coming into these roles. Maybe they're doing the trading, maybe they're helping with some of these funds that are out there. And anyway, so just some food for thought that we may see more of these little mini bubbles as people are trying to invest and take on some risk in areas that hopefully won't have devastating effect on the overall market, but we might see some things here and there that cause some issues. But by and large, things take time. Um, and so we're just going to be steadfast, and we're going to try to identify the long-term trends and hop on for the ride, and let it take us where it will, and not try to be home run hitters, but we're just trying to get on base. And if we can keep getting on base, eventually we score runs, and we get to where we want to be. So hope that is helpful. Hopefully you guys have a good week and a good President's Day weekend, and we'll see you soon.